factors influencing the role of money. By the end of this presentation, you should be able to define and explain the factors that influence the role of money. You should also be able to assess the different influence the factors may have on the role of money. Let's start by looking at the basics. So, the role of money can be influenced by your attitude to risk and reward. Now, there is a saying in life that the greater the risk, the greater the reward. Now, this all depends on your own perception to where you are. Are you risk favourable or risk adverse? Now, if you notice on the right-hand side of your screen, you'll see that the increased side is a red arrow, and obviously the reduced risk is going to be the green arrow. So, in theory, if you want to be playing it safe, you might save money. You might only spend money that you have, and they tend to be the low-risk options. And when we say saving money, that'll be saving money in the bank, where they pay you a set amount of interest. It may be typically a small amount of interest, but it's safe. You can go back to that money from the bank and take it out. Alternatively, an increased risk approach might be to borrow money, or it could be maybe to even invest that money in the stock market, for example, that you've got, because that's an increased risk because you're not guaranteed to get the same amount of money back that you're going to put in there. But, of course, for that risk that you may lose money, you may also make more money, so getting a greater return than saving the money in a bank. Borrowing money again. You may choose to borrow money to buy an asset which is more expensive than the money that you've got in your bank account, knowing full well that you could sell it on for a greater amount. Think of people who set about obviously investing in a business or property development, for example, or maybe even buying something at an auction like an antique that they know is expensive, but if they were to hold on to it, they could turn a greater profit on their yield. You could also argue that spending money on a credit card is also deemed to be an increased risk, as opposed to living a life where you spend money that you've got. Because, of course, a credit card isn't your money, so you've got to pay this back. So that involves an element of management and financial management, and that's one of the key skills that you need to manage if you're going to have a credit card. Of course, remember, credit cards come with an element of risk because you have to make repayments based on the interest that it costs you, and that's why they're deemed to be an increased risk. But of course, again, it's a greater reward because you can buy larger scale items. Now, I would like you to have a look at this table. It'd be a good idea if you pause the video in a minute so you can complete this table, and then I'll run through the answers with you. Now, one of the factors that influences the role of money is the different stages of life that we are in, and they will impact how we use money and how money influences how we're going to use it. Now, different stages I want to look at are childhood, adolescence, young adult, middle age, and old age. And if you notice, I've got key features and financial needs. What I'd like you to do is to pause the video in a moment, but try and fill that table in. So try and think of the key features. So what would be the key features of childhood? What would be the financial needs when you're in childhood? And then try and fill the table all the way in. And then when you unpause the video in a minute, I'll go through the answers with you that I've come up with. Pause video now. Okay, let's have a look at some of the answers. So, let's go through the childhood form first. So, the key features of childhood. Well, it depends on parents for finance. So, as a child, you tend to rely on your parents that are going to give you finance. And you tend to be encouraged to save because it's one of the key things and key skills that parents try to instill into young children about saving. So, you've probably got a little bank account somewhere to save your money. Low risk. And all about managing your own finances. Now, your financial needs are probably going to be quite small because your personal finance needs are going to be more about saving money. Maybe you might have a trust fund that your parents are paying into on your behalf that matures when you get to 18. But you're probably going to rely on your parents mainly for your source of finance, or maybe even some family and friends that give you money each week, or maybe some pocket money you're being given. However, your financial needs are probably going to be quite small, not that great. Well, when we move into adolescence, let's have a look at it a little bit differently there. So now, typically, you're probably still going to be dependent on your finance coming mainly from your parents. However, you may now have a part-time job, part-time employment, because you're starting to become more mature. There's more expectation being placed on you and more responsibility being placed on you to finance yourself. Of course, what you're going to see in your financial needs are probably going to change now. As you become into the adolescence role, you're probably going to see increased levels of financial needs. You're going to need to spend more money, and you're probably going to see your savings start to decrease. You may be using your savings. Probably parents are putting pressure on you not to use your savings. So that's where your part-time position comes in, paying for your mobile phone, for example, or you want to go out, you want to do different things. You may also potentially, getting towards the end of the adolescence phase, so let's say 16, 17, you're starting to consider that phase of you want to buy a car. That could be a large purchase, so you've got to consider about saving for a car, for your first car, save for your insurance, or for some expensive item that you're looking to purchase. Then, of course, we go into young adult. And in young adult, you've got increasing levels of spending and your financial dependency. Your borrowing is probably going to start to increase in this stage, and your savings are now going to probably be rapidly decreasing. Some people may be still saving, but most of you probably be looking at this stage to spend lots of money on high value items. Now, of course, your financial needs tend to become from things like maybe buying a home, for example, or it could be from maintaining a home, or it could be buying a car, or even considering starting a family, because children are quite expensive to finance. And what you tend to find now is that you're going to see your savings really deteriorating at this stage now. As you move into middle age, you're going to see that the levels of borrowing maybe are starting to decrease, because maybe your mortgage is starting to be repaid. You're going to start to increase savings because you're starting to plan for older age and when you want to retire. Consider that. You may be looking to invest more money. So maybe at this point now you feel that actually you could invest them savings you've got, looking for higher risk, for a greater reward that you're looking for, because you're trying to plan for the older age when you want to start to reduce them levels of risk, and you feel that you've got that money to spend now. Now, of course, reducing financial needs are also happening because maybe your mortgage is starting to be repaid. Children could be leaving home at this stage. You are now starting to see that you've got less borrowing, more money available to invest. And as a result of that, typically you may start to look to buy stocks and shares or different forms of investment. And then, of course, lastly, you've got your old age. You're going to see a reduction in your financial dependency of others, because at this point now you're probably going to be looking after yourself. And you're going to see an increasing level of disposable income. They actually call this the grey pound. So old people are deemed to have quite a large level of disposable income. However, they tend to be mainly living off their savings, but that is probably something that's starting to change more and more as we're seeing people working into older age. And you have to consider that some people are working still, even though they are actually at retirement age. So they've got very large sums of disposable income available to spend, and obviously they may still be looking to invest that money. However, typically older people tend to be seen to be reducing their financial risk. They tend to be looking to try and live off their savings and pensions. They just want to effectively have enough money to cover their living costs and a good standard of living. However, saying that, again, the generalisation there is quite a lot of older people who are now expected to start to look to invest more money in stocks and shares. And that's how the different stages of life will impact on the different influences that money has on you. Cultural, religious and ethical beliefs. Now, it's quite fair to say that different cultures, religions and ethical beliefs have different attitudes to money. One of the main standout ones that I want to look at is the Islamic finance model. This is because one of the fundamental principles of Sharia finance is that money has no intrinsic value, but it's purely a medium of exchange. Money should not be made from money itself, but through legitimate trade in goods and services. Now look at that line, that's critical what it says. That money has no intrinsic value. So that goes against one of those principles, what we said before about money itself has no value, but it's a medium of exchange. So it talks about that principle of exchange. And money should not be made from money itself. So that means that you can't charge interest. But let's have a look how it actually works. So, you want to buy a car which will cost you £10,000. Now, because you can't lend £10,000 and charge interest on that, because that'd be making money on lending money, what will happen is that rather than like the traditional approach, like say where the bank would lend you the money, the lender would actually go and buy the car for £10,000. But They will then sell the car back to you for £12,000. So that's actually where the profit's being made, because they paid £10,000 for the car and you're going to pay £12,000 for the car. Now, if you want to think about that, this is now going to mean that a loan is going to cost you over a year £1,000 per month. So every month you're going to pay £1,000 back. After 12 months, the car is yours. But if you look at that there, the lender's actually made a profit of £2,000, but not from the money they've lent, but from the exchange of a product or a service in that sense. So that's how it works in the Islamic banking world. And that's because we have different cultural and ethical beliefs when it comes down to lending and borrowing of money. Your different life events can actually have an impact on how you use money and how it's impacted in the life cycle. Now, we could be here all day looking at these, but some of the ones I just wanted to pick out which could possibly have an impact on a standard life cycle we think about. So, for example, getting married could potentially mean that money is seen as more of a unit of account, and the value is actually very much distracted away from the event because people are going to spend large sums of money. Typically, they're going to borrow money, and as a result of borrowing money, they're going to try and have this lavish and memorable occasion, which then they're willing to take out debt for to repay over a period of time. Now, of course, that can have an impact on, let's say, that phase we looked at about investing. If you've had a wedding, let's say, when you're 35, and then maybe that's going to cut the amount of money available to obviously invest in the markets in the future. Fear of redundancy, for example. If you've got a fear of redundancy or any form of uncertainty, a fear of redundancy could impact on how money is seen and used. So, for example, if people are unsure about the future, then they might look to save money. And they could do that because they're fearing the worst. And again, that could potentially adjust how people feel in that life cycle. So you may not buy a house, for example. Look at the stories at the moment about first-time buyers and people obviously unable because of the market conditions to buy a house. But some people may not buy a house because they fear that the market conditions aren't good enough at the moment for them to buy a house. And they, as a result, may try and avoid taking out any loans because they fear, will they be able to pay them back? And that's one of the consequences of taking out a bank loan. Again, this area you can look at and do a lot more research into. These are just some thoughts that I'm going through on these slides here. Now, you've got external influences. Now, there are many different external influences and trends that will impact on the role of money. However, the major external influence is the state of the economy. And the economy typically goes through what's called an economic cycle. Now, if we start at the growth phase, and the growth phase typically is the area which is highlighted here. So this little area here where it's growing up there. And then we move into the boom phase. So you see that the economy is becoming more saturated. Before we slip into recession, when the economy starts to shrink in size. And then we reach the slump phase at the bottom there. And then the whole cycle starts all over again. Now, the different cycles will impact on how people use money. Now, I'm going to go into more detail and get you to think about that in a minute with a little task. However, as well as the economy is an external factor, you've got things such as taxation. You've got levels of consumer confidence. You've got the unemployment rate. Believe it or not, we've just seen one in the UK at the moment. You've got government and elections can have an impact and an external factor that they can't control on how consumers use money and how they spend it. It can even have things such as like the Bank of England's policy on quantitative easing and how they use that, which can have an impact on how they spend it. What you'll see now is you've got a table that relates to each of the different stages in the economy. You've got your growth stage, your boom stage, your recession stage, and your slump stage. And what I've done in the other columns on the left-hand side, I've got what will be happening to spending, what will be happening to saving, what will be happening to interest rates, and what will be happening to levels of borrowing. And I would like you to spend some time seeing if you can complete that table. You could even share your answers below so that other people can look at them and discuss them with you. Please do pause the video and complete the table. And when you unpause it, then discuss your ideas with a partner before finally discussing them with your teacher. Okay, pause the video now. And let's move on forward again. The interest rate can potentially impact on how people will use money, as this can adjust the cost of borrowing or the actual reward for saving. So, for example, if the Bank of England on the left-hand side, as you've seen before, If they were to increase interest rates, so they were to put it up, then the cost of borrowing would also become more expensive because banks would naturally charge you more to borrow money in the form of the interest payments they charge you. However, as a saver, you'd also benefit because then banks would give you a greater level of interest and a greater level of return for the money that you are choosing to save with them. Of course, if the opposite was to happen, and if interest rates were to decrease, then the cost of borrowing would also decrease. So that would give you a greater incentive to borrow money. So people may go out and spend more money, especially on larger purchases. However, the reward for saving would start to decrease. So again, that may form an opinion in people's minds that they need to go out and spend money, which of course would change the attitude to money and the attitude to saving. And that's how interest rates have a real big impact as an external factor on the way that people value money and use money. And that's it. At the end of the session, you should now be able to define and explain the factors that influence the role of money. You should also be able to assess the influence that the factors can have on the role of money. Now, in this presentation, we've looked at some examples. Of course, I'd advise you go away and carry out many more areas of research. It'd be impossible to produce a video that covers every small section, otherwise it'd be here all day. And as much as I'd love you to watch YouTube all day, I think it's best that you go out and you start trying to spend some of that money. Don't forget to follow me on Twitter, it's at BeeBusinessBee. Check out the webpage, it's BeeBusinessBee.co.uk. And don't forget to press that subscribe button down below and subscribe to the BeeBusinessBee YouTube channel. And until next time, keep buzzing. Thanks for checking out the BeeBusinessBee YouTube channel. Don't forget to click the subscribe button down below to subscribe to our YouTube channel. Don't forget to follow me on Twitter, it's at BeeBusinessBee. Also, give the Facebook page a like, it's facebook.com/BeeBusinessBee. And lastly, don't forget to check out the online hive of activities found on BeeBusinessBee.co.uk, full of quizzes, activities and resources. And remember, until next time, keep buzzing.